Hello, this is Kevin Donahue, Senior Director with Protiviti, welcoming you to a new edition of Powerful Insights. In this episode, we are going to be talking about all things around initial public offering, or IPO, readiness. And spoiler alert, there is a lot. Accounting, financial reporting, cybersecurity, and even ESG and climate reporting. Joining me today are Stephen Alicanti and Kristy Balsanek from DLA Piper, and Charlie Soranno and Andrea Vardaro Thomas from Protiviti. Stephen and Kristy both are partners with DLA Piper, while Charlie and Andrea are leaders in Protiviti's Business Performance Improvement Solution. Thanks for joining me, everyone. Let's dive right into our topic here. And Charlie, I'm going to start it off with you. We know that preparing for an IPO is a long and intense process, requiring months or even years of preparation. In your experience, what areas typically become the so-called long poles in the tent leading up to an IPO that companies should consider?
Kevin, there's certainly a lot. A couple of things that do come to mind are the accounting and reporting records and processes, and then prepping for those PCAOB audits. So if you think about the accounting and reporting pieces, generally what companies struggle with and we help our clients through is unwinding the private company accounting. Let me give one example there. So a private company does a business combination where maybe the excess over purchase price is recorded as goodwill. And as a private company, they can actually amortize that goodwill. As a public company, business combinations, any excess is allocated first to intangible assets, either finite or indefinite, and the remainder then allocated to goodwill, which is not amortized in a public company setting, but assessed for impairment periodically. That appears to be kind of a one-time finite item, but it has to be done at the earliest period presented in the financial statements that go to the SEC, and then every year after that. In terms of the getting ready for the PCAOB audits, four things really come to mind. SEC ready financial statements, of course. Higher auditor scrutiny. What does that mean? It means more sample sizes and lower levels of materiality that the auditor is going to be looking at. The auditors have to gain an understanding under AS5 of the internal controls over financial reporting, which is a new protocol for companies looking to go public. And the auditor has to reestablish their own independence, which is not a client protocol, but it is a auditor protocol, which could delay the process. I think Andrea was going to weigh in on some of the other items, including segmentation.
Yeah, Charlie, one of the long poles that I often see is how a company decides to disclose externally their segments. And, it's important because it impacts not only how the company is managing their business, but the segments also form a basis for how the company develops and communicates their equity story in the IPO. And then also as a public company, how they continue to report their financial performance in SEC filings and to the street. So what we see is a lot of times there is a need for changes or updates to financial reporting structures or data hierarchies to align with the new segments. And when companies start to determine what their segments might be, the focus might be on benchmarking to make sure that they're comparable with other peer public companies, especially as they're disclosing externally. But you have to think about SEC reporting in the vein that it's frequently a target for SEC comments. So when making the decision around segments, you'll need to consider adherence to U.S. GAAP requirements and be able to support how information is being presented to that chief operating decision maker, so the CODM. And the CODM receives the management reporting packages. So it's really aligning information with how it's being presented to the CODM and also how it will be used for future discussions with investors and analysts. One other area, moving on from just the accounting side, is on the forecast and forecast accuracy. And it's, as a public company, it's critical to have accurate forecasts that can demonstrate quality of earnings, instill an investor confidence, and allow management to identify and evaluate any potential risk, opportunities, and even uncertainties that might have an impact on the company's financial projections in the future. What I see many companies struggle with is consistency of forecast accuracy and also the ability to produce a timely forecast. And most of the time, this is really due to a lack of accurate data from underlying systems or even team capabilities. And it's not just the financial modeling capabilities. It's also how they're connecting the financial forecast to the business and the business strategy. And I'd say that improving forecast accuracy does take time and many reps that are needed to prove it out, right, over the course of time, adding those improvements in, which is why it tends to be that long pull for many companies that are preparing to go public.
Great. That's great rundown by both of you. Thank you. Stephen, I wanted to have you jump into this question as well. I know there are some issues related to, say, business combinations and acquisitions that come into play too.
Sure. Thanks, Kevin. So there are business combinations and significant acquisitions are things that have to be monitored carefully when you're contemplating an IPO in the future. Typically, transactions of that nature are governed by Item 305 of Regulation SX. Generally, if you close a significant acquisition, you're required to include historical target financial statements as well as pro forma financial statements. And the rules are complex. There's some latitude depending on the significance of those acquisitions as to when the financial statements are required. And generally, they're based on three quantitative tests: the investment test, the asset test, and the income test. If you have an acquisition that trips the 20% threshold in any one of those tests, you'll need 1 year of audited financial statements of that target company, plus a stub period. If you go over 40%, you'll need 2 years of audited financials, plus a stub period of that target company. And then you'll also need pro formas. There are also rules around aggregating multiple acquisitions that may not be individually significant. The good news is that if historical financial statements of a target company are required, it's not necessary to have those and be PCAOB audited. So you can have a traditional AICPA audit for those target financial statements. The other long pole that jumps to mind for me is stock compensation. So as you're approaching an IPO, keep in mind that the SEC typically scrutinizes stock-based activity in the 12 to 18-month period preceding the IPO. So, for example, if the company is issuing options or warrants to executives, that may be deemed compensation. It may be very straightforward compensation. And the SEC may determine that an accounting charge is appropriate for purposes of that compensation. What will happen is that the SEC compares those prior issuances against the midpoint of the range in the IPO. Now, the thing that's thorny about this is that companies generally disclose the IPO price range in an amendment to their S-1 after they've cleared all other SEC comments. So this is an issue that can come up very late in the process while you've commenced your roadshow. And it can be very challenging if the SEC disagrees with your analysis. If they require an accounting charge, you'd have to go back, potentially restate financials. So this is something that if you're thinking about any equity issuances in that time frame, definitely consult with your external advisors. 409A valuations may be required, or accounting charges may also be required depending on the circumstances.
So these long polls certainly are a challenge for companies. And we see they're primarily focused on requirements to prepare the company in advance of an IPO. However, oftentimes, once these companies are public, they struggle with being able to keep up with incremental demands required of a public company. Andrea, how should companies be thinking about readiness to become a public company after the IPO is effective?
Yeah, it's a great question. And I think once a company's determine what their long poles are, they should shift focus to addressing the long pole to de-risk the IPO timeline and ensure that if there's any important dependencies or overlaps, that those get addressed. And we typically refer to this as infrastructure build out. I'd argue that infrastructure build out is the most important phase of the IPO journey for most companies. Because when companies start their IPO process, they tend to focus on the incremental work around the transaction itself. So drafting the S-1, the analyst day preparation, roadshow. But once all of the third parties that are assisting in the transaction go away, the company does need to stand on its own as a public company. So this means being able to file quarterly 10Qs, annual 10Ks within the SEC reporting timelines. And then there'll be additional activities. Think about investor relation procedures. So quarterly earnings release, analyst call. So all of those procedures will need to be implemented. So part of the infrastructure build that we always recommend is to conduct a mock public company quarter in advance of the IPO. And I actually recommend doing this no less than 2 quarters prior to the effective date of the IPO, because you want to have enough reps in place so you can work out any issues and really build the muscle memory across the company. So when we say a mock public company quarterly process, what does that actually include? I recommend first starting off with creating that calendar and the formal processes around that calendar for those incremental activities that the companies might not be doing today as a private company, but will need to do as a public company. So an example of some of these newer incremental activities that we often see is that companies might not prepare quarterly tax provisions. Obviously, there's no drafting of a 10Q or review of that 10Q document, incremental quarterly audit review procedures, so the SAS 100, earnings release, analyst call prep, 302 and 906 certifications, quarterly disclosure committee. So those are all examples of most activities that private companies are not doing. And when you think about those incremental activities, they all need to be completed within the SEC timeline requirements, and that's generally 40 to 45 days following a quarter end, depending on the filing status. So because there's all these new incremental activities that are required as a public company, we see that most companies need to find ways to accelerate their financial close process. Ideally, the book close is about 7 to 8 days after quarter end to make sure that they can achieve all of these additional activities. And then, as I mentioned earlier, being able to produce a timely and accurate forecast and quarterly financial projections is also important in this process as well. So when we think about conducting that mock process, I would start with the process itself on dates that are achievable, not necessarily within the public company timeline. So you can form that basis for identifying challenges and opportunities, and then identify those opportunities to implement ongoing refinements, enhancements, and continue that mock process so the company gets those reps in place. So by the time you are public, it's second nature versus a fully new process.
And Charlie, I'd like to get your views here too, I guess from a SOX perspective and the requirements that are in place on that front.
No, happy to. As Andrea points out, the infrastructure build, starts early, and the internal controls, SOX should start effectively at the same time. There is a fallacy out there where registrants or potential registrants, when we meet with them early, they might believe that Sarbanes-Oxley requirements really just start kicking in when the auditor may be providing an attestation of the internal control function. And for smaller companies, emerging growth companies and the like, that could be as long as 5 years. But companies really should be preparing, well in advance, right? So the management's assertion over internal controls really has to be done at the end of the first full year after becoming a SEC registrant, right? And what that means in summary is the risks have to be assessed, processes have to be well documented, the controls have to be evaluated for design effectiveness, and then they have to be tested for operating effectiveness. So management has the ammunition to be able to say, yeah, we believe our internal control environment is sound. And that's done at the end of the first full year after becoming a public registrant. However, the first periodic filing after a company becomes a registrant, which is typically a 10Q, a quarterly report, the CEO and the CFO have to assert to a soundness of the internal control environment under Section 302. And then you might be saying, well, isn't that Sarbanes-Oxley? It is. It's SOX light, if you will. So we recommend to our clients that high-risk processes get documented and tested, which would include revenue recognition and then also kind of the financial close and financial reporting process. All of that should be started to be evaluated, as Andrea points out, in the infrastructure build protocols.
Yeah. And Charlie, to add to that point too, and just to circle back to Stephen's point earlier on the business combinations, We often see that after an M&A transaction, integration of systems and processes, even integrating the organization, especially the CFO org, that has a significant impact not only on the company's ability to meet the public company timeline, but it also has an impact on internal controls. So as you think about integrating any new acquisitions during your IPO journey, you're really going to have to think about, do you have compensating controls, mitigating controls? There might potentially be significant deficiencies or material weaknesses that need to be disclosed. So, those are all considerations that you'll need to think about in advance of the IPO. And then as you continue the journey as a public company and building out your formal SOX processes.
And I think Andrea and Charlie hit on, the common theme here. The IPO is really the first step in the process. The experience from that IPO process, from a drafting disclosure and the due diligence exercise that the company goes through with its underwriters, will certainly help prepare the company and its management team for some of the disclosure obligations as a public company. But strong corporate governance, effective disclosure controls are going to be paramount, and that's part of the infrastructure build out that was mentioned earlier. If management teams and the board have limited public company experience, they need to be realistic about their internal capabilities and the need to involve external advisors. From a legal perspective, once you become a public company, you're going to be subject to a new level of disclosure obligations, transparency that's going to be very foreign to people that are used to operating with private companies. Oftentimes, there's thorny issues that arise, and they require rapid decision making. It could be cybersecurity, an event, or other events that require disclosure. And you want to build trust in the market that you have timely and accurate reporting. Public company readiness assessments are one way to help a company understand where you're at and where the company needs to be in the process to function effectively as a public registrant.
So, Charlie, as a public company, there are also certain disclosure requirements that companies need to adhere to. One is the rule adopted by the SEC last year in 2023, which requires public companies to make certain disclosures related to cybersecurity risk management, strategy, governance, and even incident disclosures. How should these companies think about preparing for this rule as part of their public company readiness efforts?
Well, this is the part of the presentation where we say nothing ever comes off the list. So yes, as you mentioned, Kevin, the SEC put these new rules out in late 23, and there's two components to it. It's the 10K component and the 8K piece. So the 10K component is really the company's backbone to identifying and mitigating and disclosing cyber risk activities, right? The risk management over that process and the governance, meaning the board, the audit committee, and others in that. And what we're seeing often is cyber experts being added to both the board and the audit committee. The other piece of it is the 8K disclosure, or the incident reporting piece, which is required 4 days after an incident is deemed material and describing the nature of the event and the remedial actions taken and any financial impact that has been determined.
Kristy, let's bring you into the conversation here. In March of this year, the SEC adopted rules to enhance and standardize climate-related disclosures for investors. Now, there have been some developments there. We're going to talk about that in a moment. But first, what steps should a prospective public company take now to prepare?
Thanks, Kevin, so much. And you're right, there was in March of this year an approved landmark climate disclosure reporting rule from the SEC. And the intent for this rule is really focused on enhancing and standardizing climate-related reporting for public companies. And as many of you may know, there's been a number of different standards globally around the world that companies have had to navigate, and there's a lot of differences between them. And so what this rule basically for companies to think about going forward is to take two main steps. And the first one is that readiness assessment. And the second step would be on remediation. In terms of readiness, that's really to assess what the rule requires and whether or not the company has already implicated those rules or not. And essentially, there's about 5 main requirements that the SEC rule has put forward. And that starts at the governance level. So thinking about whether a company has a board oversight for climate-related risk, disclosing what the management role is in climate-related risk, how it's identified, how it's assessed. And what we're talking about are risks that climate has on the company itself. And so in addition to governance, there's also requirements around disclosing material climate-related risks, and also about disclosing targets and goals around material risks in that area that will have to be considered. And that's also inclusive of the use of carbon offsets or renewable energy credits, also known as RECs. The biggest change here for requirements as well relates to greenhouse gas emissions and reporting around what's known as Scope 1 and Scope 2. And those areas of greenhouse gas emissions, many companies haven't had to measure or think about disclosing that type of data. And that relates to greenhouse gas emissions that are material for the company, that relate to what they already own or what they're purchasing, electricity. And so companies are really going to need to think about whether they're already collecting that information and how they may think about whether it's material or not. What's known as Scope 3, which would then entail greenhouse gas emissions for the entire value chain, that is not inclusive of this rule. There was a lot of controversy about that, but it's not in the final rule. But the Scope 1 and Scope 2 are for certain filers, and that would relate to, again, if it's material or not. And then there's financial information that would have to also be disclosed that would relate to costs and expenses and other data around climate. So really thinking about what those requirements look like will be important to go through. How to remediate. Is there a gap between what companies are doing now versus what they're going to be potentially required to do? And one of the key things in terms of thinking about how to remediate, of course, putting a cross-functional team together to assess what these requirements look like, how you would assess materiality, what kind of data will be collected, identified, and disclosed, and what the timeline will be. But one key piece of this are these global frameworks. The SEC, of course, is just one. And so a lot of companies are reporting voluntarily through other types of frameworks that people may be familiar with, which is the ISSB or SASB, GRI, Greenhouse Gas Protocol. There's a lot of different acronyms out there, but there are standards that perhaps there's data you already have that you can leverage. And then in the US, there's also at the state level, at least on the US side, California has already issued bills that are requiring Scope 1, 2, and 3. And it doesn't matter if it's material or not. But those requirements for California are coming into effect soon. There's a timeline phase in as well. And then the EU, for those who are operating globally on the EU side, there's a directive for corporate sustainability reporting that goes beyond climate that companies will also likely have to be looking at as well. So that is really something to navigate overall and to think about what can be leveraged in order to address any gaps with the SEC rule.
And Kristy, as I mentioned, and you noted as well, there have been some developments. So in April this year, or 2024, the SEC issued an order pausing the implementation of all of this, I imagine, the final rule requiring companies to disclose climate-related risks, pending the outcome of a legal challenge to this mandate. So I guess in short, what does that mean for companies as they enter into their preparations to comply with this requirement?
That's right, Kevin. So immediately after the approval, within basically the same day, there's been numerous lawsuits filed, and they've all now been consolidated into one circuit. So it's one consolidation, and we're now waiting to see the results of that decision. And the SEC voluntarily stayed. So this is important to recognize that it was a voluntary decision, and the rule's been stayed, and we're going to wait and see what the time frame may look like. There's another important lawsuit that we will be waiting to hear from the Supreme Court, which relates to regulatory authority. And for those who may be aware of it, it's the Chevron case, and that will be coming out this month in June. And so the current SEC lawsuit is being waited on for this Supreme Court case to go forward. And we'll see what the decision is in terms of, again, regulatory authority. But in the meantime, the timeline looks like at the SEC lawsuit with the Eighth Circuit that it likely will be either end of this year or early next. And then, of course, it could be appealed again, potentially up to the Supreme Court, which would be another year of timing. So in the meantime, we're still recommending that companies still look and understand what the SEC rule requires on climate. And again, because there may be parts that are struck down, but there may be parts that do get upheld. And so it's important to understand what the requirements are. And again, as I mentioned, there's a lot of global frameworks already in place. And there's in the US, the California state requirements as well. So how this all fits together to try and proceed efficiently in a manner that will address these differences, but try to be more standardized, we'll have to wait and see. But it's important to start early because there's a lot of data gathering and changes within company to think about in order to adhere to these rules.
And Kristy, a quick follow-up to that, I guess to emphasize your point, you mentioned the different state laws like California requirements, but in addition, with CSRD, that's not just impacting companies based in Europe. It's anyone operating there, perhaps even a vendor of someone operating there. So the point, I think, if I'm understanding, is you can't really afford to delay, even if the SEC's rule is being delayed.
That's right. And because the EU is very broad, and while the initial phase in the applicability will start on the EU side with EU companies, but subsidiaries of US companies may be pulled in depending on the number of employees and your amount of revenue. But also, as the phase-in occurs, it may come up to the parent in the US even. So there's a lot of applicability assessment that is recommended to be undertaken. And also, to your point, the word for the directive in the EU is sustainability. So while the US has been more focused in the SEC in California on climate, sustainability for the EU covers climate, it covers social, business, human rights, diversity, inclusion, and the governance piece is really critical as well. So it's quite broad.
Excellent. Well, thank you. Thank you, everybody. This has been a great conversation. Just a final wrap-up question. Andrea, I'll toss this to you first. What advice would you have for companies seeking to go public? How can they avoid the common mistakes a pre-public company makes that could negatively affect the organization's short or long-term success as an SEC filer?
Yeah, and I think we've talked about a lot of these points, but I would first recommend, doing that initial upfront assessment, understanding what your current state is now, and identifying what are the long poles, what are the heavy lifts that your organization needs to undertake, and then shift that focus to infrastructure build out to make sure that the company can function successfully once it is public after that transaction. But during the process itself, through that IPO journey, I'd recommend making sure that there's an adequate program management structure in place to drive that IPO readiness effort. Establish a steering committee. That steering committee should be made up of key stakeholders throughout the organization, not just within finance and the legal side, but also from an HR perspective, technology and the business side. Should also include relevant third-party advisors and even the audit committee chair. And this committee should meet frequently, so typically monthly, to review the project status, any major milestones, remediation of those long poles that have been identified, and to address and surface any challenges or potential dependency delays that might impact that IPO timeline. And this can help track the IPO preparation. It can help track the infrastructure build once the company is public and allow the company to make a realistic go or no-go decision once the IPO is imminent.
And Stephen, I'll ask you to share your final thoughts before we close things out.
I think Andrea hit the nail on the head. This is a long road. Be patient, be careful, undertake the assessments up front. I think that advanced preparation will serve you well in the IPO process and then as a go-forward public company.
That was a great conversation. I want to thank Stephen, Kristy, Charlie, and Andrea for joining me today. A couple of key takeaways. This is almost certainly going to be a very long road for any private company planning to go public. They're going to have to look at cybersecurity, financial reporting, climate reporting, and much more. It's important to start and prepare early. For more information, I encourage you to visit the DLA Piper and Protiviti websites for more information on preparing to become a publicly held organization. And finally, as always, I encourage you to please subscribe to our Powerful Insights podcast series and review us wherever you listen to your podcast content.